You don't get clarity when life's easy. You get clarity when it's really hard. And one of the things I learned going through all of that back in the mid-20 teens was that I'd never wanted to work for money alone again.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome everyone to another episode of Spur Equity's Spur Your Wealth podcast. We are your hosts today, Param Singh and Rav Singh from Spur Equity. And so on our Spur Your Wealth podcast, as you know, we aim to bring successful investors and experts and thought leaders to our podcast to share their story and secrets in investing so we can all stand to benefit from their experience. And so today, on today's episode, we have a successful sales executive turned successful investor entrepreneur, David MacLean, with us today. David is, his real estate experience is vast, spanning over 20 years, where he's owned multifamily units, commercial retail developments, single family properties, vacation rental properties, second homes, and custom builds. So the gamut, all around different types of properties. He's founded Mac Assets in 2019, and in its portfolio currently includes property in the Southeast and Mountain West of the United States. And at present, he's the general partner in over 1,000 doors. Really, really impressive. Welcome, David. So happy to have you on the Spur Your Wealth podcast. Really looking forward to the conversation today.
Thanks, Param. Really great to be here. Appreciate that. And it's no longer 1,000 plus doors. We sold 400, so now we're down to a little bit over 600.
So you made good money.
Excellent.
So you made good money.
That's great, man. Great.
We exited.
Cool. That's great.
Yeah.
So, I give a little brief intro, but, I know your journey into real estate and with your background, I think people would really be interested in, how this journey kind of started for you in real estate and how you took off the golden handcuffs, so to speak, from your previous life. So if you could share a little bit of that would be really great.
Yeah, I'd love to. So I do host a podcast called Break Your Golden Handcuffs, which is why Param keeps talking about it. And I got to get my plug in early.
Yeah.
So the reality is that I went to work in the ad field, got a degree in advertising, was on the business side of it. So not the sexy Don Draper side, but the boring, how do you place the ad where so somebody sees it side. And I was pretty good at it. And I ended up leaving that to go become a sales guy. I was given a phone book and no list and 100% commission gig. And they said, go sell. Mm-hmm. And for a lot of the listeners that don't know what a phone book is, it's this really heavy thing that published phone numbers of businesses. And you had to go dig in. And there was at the time, literally no internet yet. It was just in its infancy. I think my email was about a year into the job. And so I started with nothing, and I had to go create an entire roster of advertisers. Over the course of 17 years, I became one of the top 3 in the country, based out of Denver, competing against New York and LA and Chicago. So that was a really big outlier deal. What was amazing about that rise was that I would get one big client, and I would run with them for a couple of years, and then they would fall apart, and I have to go get another big client. I'd run with them for a couple of years, and then they'd fall apart. And over the course of time, it became obvious to me that there was never a guarantee. And so I worked, and I made really good money, and I grew in the career, and I ended up leaving the place as a regional VP in charge of $1 and $3 in the company. And I was laid off because there was a merger. And you guys are in San Antonio, right? That's what my memory tells me.
That's right.
And so that beautiful company headquartered in San Antonio bought my company. And if you know anything about the ad business, there's this little small company called iHeartMedia, headquartered in San Antonio, and they own about 2,500 radio stations around the U.S. And there were 2 of us at the time, and they bought us. Our competition bought us. As soon as the Department of Justice approved the merger through the antitrust concerns, the next day they laid off everybody at my executive level and above, and all of us were gone. And it was really hard. So I lost my job, went through a really nasty divorce at the same time, ended up recognizing that I was now a single father where I had heretofore run 24, 26 states. And I was on an airplane every day. Monday morning, I'd take off, or Monday afternoon, I'd take off. I'd come home Thursday night, Friday morning. I'd be in one or two time zones. I'd be working with my teams out in the field. And I went from being somebody to laid off. And in the course of a day, I had a career and then I didn't. And I remember thinking about my father in the 80s in Oklahoma lost his job when the oil booms fell. And I'm sure you got listeners in Texas, and we all understand the vagaries of the energy business.
Yep.
And what I realized from that was that there's no guarantees in life professionally. At my heyday, I was making 7 figures selling advertising, which is unheard of. And so I was very cautious when I did that to know that I had to steward that money somewhere, somehow, in a way that was more beneficial to when the end came. Mm-hmm. So fast forward, the end came. I went through this really nasty divorce. I ended up becoming a chief revenue officer after that for a tech startup. And we were competing against what is now very ubiquitous, and it was the QR code. But the QR code at the time was pretty ugly, and we had a marketing model that was really cool. However, $50,000 startups and free startups, the advertiser picks the free every time. So that went bust. And after that point in time, I looked around and I got in the real estate business because I was a single dad. I couldn't travel. I couldn't sell radio because I had been there, done that, and couldn't sell TV because I was too expensive. So I went in real estate in order to control my destiny. And it's been a hell of a ride. Yeah. I got my brokerage license. I got my sales license, my brokerage license. I now own my own brokerage company. And then in 2020, I got into multifamily, and that's been another interesting ride. So long story short, I've came to realize that corporate America was never going to trust me, and I was never going to trust them. And it was a disproportionate relationship whereby I would work harder and they would just ask more of me the more I worked.
Yeah.
I remember the day I did the single biggest contract in the history of the company, and it was a huge deal. The CEO called me and asked me what I was going to do next week.
Yeah. I say this over and over again because within my company, I was working in consulting as well, right? So I was working in consulting for 24 years, and it was great, like a high paying job. It was, I got to travel, learned a lot, all of that stuff. But at the end of the day, it does come down to trust. And what you said is completely right. They don't trust you and you don't trust them, right? There's very few and far between relationships with a corporate entity, right? Where, you can actually trust that you will have a job tomorrow, right? Essentially. So at some point that relationship is going to sever, or you're not going to be, at the end of the day, exactly what you just said, you would get a pat on the back for something that you just did. I killed it in terms of services and revenue that we brought in, but then they're like, well, what's your pipeline look like? So, cause you're only as good as what you did yesterday. You're only as good.
And you're not even that good.
Yeah. You're not even that
You're
good.
only as good as what they want you to be.
Yeah. Yeah. And so when you recognize that, and I'm not trying to, people that are in corporate America and following their passions, I mean, it's all great, but at the end of the day, you have to recognize that, there's a relationship there of a give and take. And so once they, I got to a company that was so big that all you are pretty much a line on a spreadsheet. It's not like that, hey, we're all a big family, and so you got to realize that this lifestyle that this salary is paying for, it's only as good as how long you stay. And so when I, we talked about this earlier about financial freedom, I thought financial freedom was, hey, I got a great salary and it's paying for the lifestyle and we're living well, and that's financial freedom. But at the end of the day, if that job goes away tomorrow, what do I have, right? What do I have left? And so that's what got me thinking while I was in my W-2 and saying, okay, I got my 401k, I got some stocks, but that's not going to pay, for my lifestyle if my job goes away. So that's same thing. I started sowing the seed for real estate and having a little bit of at least control over my destiny to say, okay, if, I had to leave, or if I wanted to leave my corporate job, I still have something that's going to sustain me and my family and my lifestyle. So, very, very similar story, right? But you have to come into that realization. And I think a lot of our listeners, whether they're, corporate professionals or lawyers or doctors, again, not to say that you shouldn't do any of those things, but we have to recognize that, and we have a lot of folks that are running their own businesses, for example, and running hotels or convenience stores or retail centers. But again, at the end of the day, it's how long are you going to continue to do that to sustain your family? And so what are the things that we need to do to build generational wealth or build wealth that's going to be self-sustaining, essentially? And that's where real estate came in for me.
But what a journey, though, David. Thanks for sharing it with us. And by the way, I want to let you know that I checked my mail the other day, like a couple of days ago, and guess what I had in there? A yellow book, an actual. You know what that is. And everybody, every time I look at it, I get shocked. I'm like, really? It's still? I mean,
it's still there.
So in San Antonio, probably everybody got it. Just FYI, right? So,
that's funny.
Well, Ma Bell still runs well. Verizon has not given up Texas yet. Right?
I guess so. So yeah. So by the way, thanks. For letting us know regarding that. And we talk about this all the time. Like sometimes clarity comes after you do so many different things. And to me, clarity comes from discomfort. It comes from just confrontation. Sometimes you have to go through that in your life journey in order to come to an exact place where you feel like, maybe now this is your calling, right? So I feel like, this is what you just explained to us, that given what you did in the past and now what you're doing today feels like maybe, this is what you were meant to do. So thanks for that. So let us know, tell us and our readers, what are you doing now then? So after your corporate America and after your, getting your real estate license and now getting into multifamily, what does that mean to you? I mean, what are you doing in the multifamily world at this point?
Well, it's a fascinating question. So I love the idea of clarity comes from, and, I have a good friend of mine and we work out a lot, and then we take a steam afterward and we always chat, and we talk about steel sharpening steel, right? And I think clarity comes from steel. You don't get clarity when life's easy. You get clarity when it's really hard. And one of the things I learned going through all of that back in the mid-20 teens was that I'd never wanted to work for money alone again.
Yeah.
So many people I know work for just money. Yeah. And working for just money got me to a place where I didn't know, costing my marriage, almost costing my kids. I had to focus in real hard to build that relationship now with them, which is fabulous. But I had to recognize that it cost me a lot of friends, a lot of money, because the divorce was not what you call inexpensive. Right. When you write a 7-figure check in a divorce, you always pay attention to that check. And what I had to come to learn was you can't work for things you don't have passion for.
Correct.
And I shouldn't say you can't, I say I can't. And I also came to realize that no one was going to protect MacLean Inc. but David.
You're right.
And if I wanted to do something, it was upon me to do it. So from that, I found multifamily, and I still have a great passion for multifamily. But in my world, the market's kind of seized. And my residential brokerage, the market is seized. I think we're going into a very challenging time for many, many people.
Yeah.
People do not understand what a Fed funds rate of 5%, 5.5% means.
Right.
And the economy is going to teach us in the next 18 months exactly what it means. My stepdaughters are 23 and 22, and my daughter's 21 and my son's 20. And so they've never had a life where the Fed funds rate was anything above 3.5.
That's right.
There's an entire generation of people that have never owned a home with a mortgage greater than 6%.
Correct.
And now we've got mortgages that are in the 7.5 to 9 range. So what this is showing me is that there's going to be a whole lot more clarity for people.
Yeah.
One of the things that I've discovered during this journey is that I really love helping people achieve impossible dreams with joy. And so I'm spending a lot of my energy working with mentees and working with people and helping them to discover what their clarities are and how to get to joy. And it's not all about money. However, I read an article today in my email that talked about the measure of happiness and money. And there's a a well-known stat that came out again today that says people with money feel happier than those without, but there's a threshold at which the gain of joy from the dollar delta in money doesn't really change.
Right.
Mm-hmm.
And it talked about a net worth of 1.2 million as kind of that number, and a household income of 75K or greater. Now, I take a little bit of umbrage at that because most highly compensated employees, and if you're an accredited investor, you're probably going to be an HCE. Most of them don't view 75K as a number where they feel satisfaction in their household income and in their lifestyle.
Mm-hmm.
But the idea is once you get to a baseline coverage, you get to work on actualization issues. And so I like helping people achieve, impossible dreams with joy.
Mm-hmm.
And I spend a lot of energy and effort doing that in addition to my real estate. Because I think that right now real estate is in a wait mode.
Yeah.
You can take action, but the distress hasn't shown up completely yet.
Right.
I don't want to buy in Texas.
Mm-hmm.
I'm the guy that says Texas is overvalued.
Mm-hmm.
I think that the cost of insurance is too high.
Right.
I think that until we have some shakeout through the Fed and the world feels a little more normal, and we have a little clarity around the two ground wars going on right now that are very substantive.
Right.
I'd rather put my money, I hate to say it, but in baseline simple place.
Yeah.
One of those is just going to be a stock tracker.
Mm-hmm.
The NASDAQ is up 18% and the S&P is up 36% this year. It's doing better than my real estate.
Mm-hmm.
Yeah.
And this goes to show the cycles that happen therein.
Yeah.
So I'm in the building the war chest for finding the right thing when it comes. I think the right thing is 12 to 18 months from now.
Yeah. And I think you're not alone in thinking like that. I think if you take a pulse, if you take a poll, so I'm in the brokerage business myself, right? I mean, and I'm very specific to what I do. But at the end of the day, I feel like there's a lot of money, a lot of dry powder that's just sitting on the sidelines. And that's going to happen for another few months or whoever, nobody has that crystal ball. And the whole idea is where people are still saying, look, there is still a big gap between where the buyer is and where the seller is. And that gap is not shrinking as fast as what either they thought it was going to happen, or what the gurus and the pundits out there were saying that all of a sudden the economy is going to go in a different direction. So that hasn't happened. And you're right. I think we're about 12 to 18 months away to really see where things are going to be. And so while that's happening, there are people who are still taking action, right? And action comes in multiple ways. Action comes in, well, let me go back to ground zero and kind of look at, my education and start looking at educating myself. I mean, that's action. Doesn't have to be that they're actually transacting, but they're learning the basis of whatever the new stuff could be that they want to learn. And then we have people who are basically just saying, look, if I look at the history of debt in America in the last maybe 30, 40, 50 years, and let me go back. I mean, rarely have we seen percentages in the 2, 3, 4%, which people were getting used to in the last few years.
Right.
It has historically been about 6 to 6.5%. And so, will we come back to that? I think so. I think where we're at right now in 7 or 8% on a residential side, even on the commercial side, even higher on the SBA side, I think the reality will sink in the next maybe year to 2 years, whatever that time frame is, will come back down to what the historical norm was in the society. And as that happens, I think people will see that transactions will still happen. I mean, I came in this country about 34, 35 years ago, and I've heard people say that, look, we used to be at 12%, 14% interest rates. I haven't gone through that. I can't even fathom that. But at the end of the day, transactions were still happening at that point, right? And so I think the new normal is sinking in. It's just going to take a little time before people will say, look, this is where we're at. Transactions still need to happen. And I'll just kind of wait around. Let me still do whatever I need to do, and I'll refi or do whatever else I need to do in the next 2-3 years as realities change at that point.
And I think the key to all of this is the cap rates. At the time when we had interest rates that were 6 to 8 points, and we had cap rates that were 10s and 12s.
Yeah.
And so it was sustainable.
It's upside down.
Right now we have cap rates that are inverted.
Right.
Yeah.
And it's not sustainable. So, I think that the bounce in this is going to be once the seller weathers the loss from the excessive exuberance, as I quote Greenspan, of the go-go late 19, 20, 21 COVID bounce. We've got to shake that out. And if you got a cap rate of 2 or 3 in a major metro, why in the hell would you buy if you can buy a T-bill at a 5+,
Right.
with zero risk? So this is part of the conundrum that we face. And I think as an investors, you've got to look at, where do I want to be? Where do we go? I'm very bullish on suburban Class B and Class C office, because I feel like so much of the gig economy and the work from home economy is going to need a whole lot more small office suite.
Right.
Like what I'm in right now. I don't want to work in my house.
Right.
I've got a 500-foot suite. It's a mile from my house. I can walk to and from the office. I get to transition and shift, and I don't work at home.
That's right.
Maybe I'm too old and too much of a geriatric to adapt to that. But I can't tell you the number of folks that say we want a change of place.
Sure.
And working in my basement is not healthy. And I think we're going to see more and more of that. And I think that one of the other fascinating trends we need to watch out for is the actual work from home force from corporate America. As we are pushing into this recession, and I was talking to someone at a meetup group last week, or a week before rather, and the unemployment has hit a bottom and started to bounce up. So we were at 3.2, 3.4 nationwide, and we're now at 3.6, 3.8, somewhere in that range. And there's a stat that I'm going to butcher, which basically says when the unemployment hits its bottom rate and starts to climb, recession is 100% factored in after that within 12 to 18 months. I would argue that in this industry, we're already in recession. And right now, the work from home forecast and the work from home model came to bear because the employee had the power. Right. The UAW strike that just got finished showed that the employee is gaining more power than the employer. And I don't know how long this work from home formula stays in its present condition.
Right, right. I think there's a blend, right? And the blend is happening.
Yes.
And the blend is happening. And people who are looking at that, and they're people, meaning companies, who are looking at that and saying, look, this is real. And so let's do a shift. Let's do a blend of a couple of days here, a couple of days there, and then be more productive. And I think those are the companies that are going to really survive and thrive in this environment. And change is going to happen. It's inevitable, right? Change has to happen. And so what goes up must come down, and vice versa. And so we just need to have these type of dialogues and these type of communication, just because, at the end of the day, we learn from each other. And so, what you said recently regarding, people are just kind of waiting because T-bills are giving you more than, cap rates are giving you at this point. All that is 100% correct. And that's why there's so much money that's sitting out there. But the action that people are doing, and I'm in 2 transactions that we have to close by the end of the year. And that is because, people are still after depreciation. People are still looking at their taxes and saying, how do I save, right? And so, so doing cost seg and doing all that, right? You've done it, we've done it, our clients are doing it. And so, everybody's in their own timeline of, how they perceive and how they look at the market itself. But at the end of the day, people who have to do stuff because of tax consequences or other consequences out there are still going to do it no matter what happens at that point, right? Because they always have explanation of, next 2 to 3 years later, as the economy changes, as the interest rate goes down, maybe I refi and get into a new product at that point.
Yeah, one of the phrases obviously is you buy the property and you date the financing.
That's right. That's right. One of our good friends says that all the time. So I agree with that. And
you've got to be cognizant of that as you go through it as an investor. What I see and what I've learned in the last 18 months as an investor and as a syndicator and an operator is that the number one most crucial thing every investor needs to look at is the financing levers. With financing not locked or nailed in one way, shape, or another, it will destroy and ruin any good project.
Right. Right? And we're seeing it today.
And we're seeing,
it.
Yeah,
I mean,
and people don't talk. And people don't talk about it.
Yeah, I mean, that's exactly what's been happening. And so, with, again, people were riding that wave, early COVID, right? And making money and transacting and, turning things around quickly. But then when it all came to head, now everyone's in this situation where it's, they're squeezing less and less and less out of every month, right? Because of that. And so we saw a lot of people pivot. We pivoted, right? I mean,
All of us have.
This year, like you said, you're really bullish on office. Rav and I earlier this year, we took a sidestep from multifamily and went to. We're still bullish on multifamily, but it's got to be, like you said, it's got to be structured the right way with predictability built in, with these finance levers, adjusted to the right reality of today. But we pivoted towards industrial, because what we saw through COVID and supply chain and all this stuff was a resurgence on industrial assets and manufacturing, where again, it's absolute triple net. So you take the property tax equation out of it, you take the insurance equation out of it. And so you have this very, very predictable, modest returns, but beating the T-bills, but you have this predictable curve of, hey, we're going to get an absolute triple net return on this investment with 20-year leases already built in, right? And so that's what
I think you're absolutely
right? And so you have to pivot and see. There's still opportunity, right? Even in these markets, but you have to find where those opportunities are, and they may not be. You can't start doing this. You can't do the same things in every market condition. You have to adjust to today's reality. And that's what people that are going to be successful in doing these things, are diversifying and pivoting, rather than doing cookie cutter approaches, thinking like this same thing's going to work, right? In today's reality, it's not, right?
Yeah, a couple thoughts from that. I have a client that he and I have been looking in my brokerage side for an industrial storage yard. Now, I live in Metro Denver, and so we're looking for something in a trading radius of about 45 miles of the entire metroplex of Denver. And the zoning is so significantly constrained that there's very little opportunity, but there's tremendously high demand. Yeah. And so when you're talking about triple net industrial, it brings to mind that this goes back to supply and demand. And I challenge every investor out there to actually think as opposed to follow. Mm-hmm. And when I'm showing out industrial property to this individual, he was running a small business, revenues $5-7 million a year, needs a 3-acre storage lot. Can't find one for less than $4 million, equal to his gross revenues, plus or minus a little bit. So is that something that's exploitable? Possibly. You look at something like marijuana in Colorado. It's been legal for a long time now, and all of the warehousing industrial got really bid up. Mm-hmm. And you see that in Oregon, you see that in California, you see that where there were leading pot states. And I think what this goes to show is that as we look at the newspaper or the yellow pages or the phone book, or as we gather our news from whatever source we gather it from, we have to ingest that news with what does it do to my thesis? Yeah. And I think that being contrarian right now could be a very positive thing. And you're being a little contrarian. I'm still very bullish on housing because housing is a mandatory need.
Sure. Yep.
And everything I've seen says that housing is at a supply shortage.
That's right.
The problem is we can't make the same money we used to make in it. And so people are decrying the poor returns because it's not as sexy as it once was.
Right.
It's still solid, still good.
Right. And you got to, and people also need to understand like the changes in kind of outlook of specific geographies and submarkets. Like you said, for example, and you're like, hey, Texas was great. Certain markets in Texas are still great, but there's specific markets that have, again, property tax, insurance, things like that have really changed the equation. You can still make returns, but they're not, 3 years ago returns. They're different. And so again, we have to adjust our realities. So like when you're looking at, underwriting, when you're looking, the same assumptions that you used 2 or 3 years ago are not going to work in specific submarkets. And so if you want to be, again, we're bullish on multifamily, but we're looking at submarkets that are going to support the population growth, the job growth, the rent growth. And even that, we're going to be very modest, right? In what those numbers look like. You can't factor in the same things that you did, years ago when you're looking at, rent growth, negative or flat,
Right.
in certain submarkets. You can't do that. And so, you have to bake in reality. And so people are using older models thinking like, hey, the same thing's going to apply. And that's just not going to work. You have to adjust. And that's what we're trying to do, and show that, we're being even more conservative in our models to show like, hey, high interest rate debt. We're looking at, property taxes, insurance in a much more conservative way from an expense standpoint, and rent growth in a much more conservative way, to show like, all right, hey, we're still going to make a return in these conservative assumptions that are baked into today's reality, and potentially even going, a little bit worse into, the 12, 18 months, ahead of us. And so if we could still make returns in those kinds of assumptions, then you're making, you're calculating your risk, right, going into something versus, again, using models that are 2, 3, 4 years, 5 years old, right?
And I think that's interesting because as investors, we don't buy on the short term. In theory, we buy on a 5-year, a 3-year,
Horizon,
a
right.
7-year, a 10-year horizon. But I think a lot of retail investors have gotten down to this. It's a 2-year horizon.
Mm-hmm.
And I challenge everybody to recognize when you buy a stock, if you're buying a stock on a 2-year horizon, you shouldn't buy the stock. And if you're buying real estate, you should buy it on a long horizon. And I think about this in terms of what expectations are for the retail investor right now and the operator. We need to make sure that our fundamentals are so sound that we can undergo the risks that are going to come over the next 10 years. When you think about the housing market, we're at a horrific supply shortage. We didn't build enough during the Great Recession. We got false financing, and we're short anywhere between 2 to 5 million housing units, depending on who you talk to nationwide. And the way that comes to bear now, there's going to be a correction, but it's going to have to be a black swan event. COVID was a black swan event that no one could foresee. Anybody that said that they foresaw COVID, I'm going to throw a flag and say it's a 10-yard BS call. Mm-hmm. And the reality is that maybe the CDC guys saw, but the real estate investing world didn't pay attention to that. So there's going to be some other black swan. And what's it going to be? And that's where I'm in let's figure out what the way to weather the storm is with enough of a delta to take the 8% increase in inflation and the 15% increase in operating costs through interest and still weather it. Because overall, I'm very bullish, but the reality is that we've had some pretty tough stressors in the last 24 months.
Oh yeah. And I think people are capitalizing on it, or people are going to capitalize on it for sure. Anybody who can survive this, I think there's that, the trajectory in terms of the curve going back up again. And so demand is there. Demand will be even there, even more. Mm-hmm. So we just have to position ourselves to be at the right place. And that's where, I keep on just hearing this survive till 2025, right? And we're basically...
And it used to be 24.
Yeah. Keep changing. But at the end of the day, like no matter what it is survival mode, right? And so you have to look at, how can we sort of beat this next 12 to 18 months, maybe 24 months, who knows what that time period is. But, once we sort of foresee ourselves in that direction there, and maybe at that point, things will be in a different direction. We're hoping so. But at the end of the day, like we as brokers and as agents and as investors, we have to keep moving forward, right? We have to keep moving forward because market is what the market is. There's no up market or down market. It is what the market is. And so we have to just recognize that, and we have to see how do we create opportunity within the market that we live in at this point.
Yeah, and what I'd say to the listeners that are highly compensated employees is this is the best time to not overly spend, but to invest. Mm-hmm. This is the best time to dollar cost average both your real estate and your stock holdings This is the time when you can make simple moves that can really affect you. And so from that point, I am very optimistic because
Yeah.
having been a high consuming employee, high compensation employee and a high consuming employee through two of these before, I know that had I not spent that money on the fancy vacation and cut it in half and taken half of that money and invest it, my dollar cost averaging across all of my portfolios would have performed much better. This is when you don't buy the new car.
Yeah.
This is when you drive the car a little bit longer. This is when you don't buy the vacation property. You invest in commercial.
Sure.
You invest with multifamily. You invest with syndicators. And this is when you take that edge off and you look at your tax structure.
So let's expand on
That's
that.
my biggest piece
So
of advice. Yeah.
As we, kind of wrap up this conversation, I wanted to get your thoughts on kind of final words of wisdom or whatever, but let's expand on that a little bit. Like, where do you see specifically, David, right? What gets you excited about where we are today? Where are the opportunities that you see going forward in 2024? What kind of words of wisdom do you have specifically for, folks that are looking to potentially invest? I love that. Like, let's curb our spending a little bit, right? And look for opportunities to invest. So what gets you excited about 2024? Where are the opportunities that you see as a broker and investor, right?
Well, a couple things. One, if you've recently changed jobs, I would definitely move money out of corporate 401ks into self-directed 401ks or solo 401ks or self-directed IRAs. One of the biggest things that wasn't able to be done during the course of my heyday in my career was take real control over my retirement funds. And that's been a Herculean move forward for corporate employees. And in the tech sectors and in the consulting sectors, guys change jobs all the time. And every time you change a job, take that old 401k and roll over whatever you want into a self-directed program and then dollar cost average it. And I think that really this is about diversification. I would diversify geographically. I would actually I'm bullish on multifamily in major metros. Demand's not going to change. And I am bullish on, if I had unlimited funds, I would buy multifamily in California. I would buy multifamily in New York. I would buy multifamily in Seattle and Austin and places where there was a geographic constraint to sprawl. And I know that political winds say you buy in landlord-friendly states. I don't know what that means anymore because it's by county. And in a landlord-friendly county, the eviction time might be 90 to 120 days. And in a non-landlord-friendly county, the eviction time might be 180 days. So the opportunity and the risk, I think, are greater. And I'd also be looking at covered land plays, and that can come in many, many forms. And then I also think about what cannot be replaced by tech or by Amazon. And one of the reasons I'm in multifamily is because tech and Amazon cannot replace housing, but they also can't replace part of the demand for medical. They evolve it. It's definitely changing. I just had a bone removed out of my hand. And so I had a general anesthesia. I went from 206 bones to 204 bones. They cut one in half, so 204 and a half. So I did this at an outpatient surgery center. General anesthesia. They took a bone out of my body in an outpatient surgery center. I was home that day. How many of those are around the country? I'm very anti-bullish or bearish on midterm and short-term rentals. I think that is going to be called to task, and the NIMBY world is going to get in its way more and more and more as much as they can.
Okay. All right. Well, this is good. I mean, I think, we've talked a lot about kind of the reality of what we're facing, but I love the fact that we're, sharing where that opportunity, where we see that opportunity lies. And so, where that optimism comes from. But I do, I want to go back to something that Rav, you said actually, is that this is also a great opportunity to really get down to foundationals, right? If you're an investor, this is the time to like like David said, right? Curb your spending, put some money aside to when you see that opportunity, whether it's with a syndicator or an opportunity, elsewhere, that you have enough available to make a difference, right, in that investment. But the other thing is foundational is education. We're really big on education, right? Anytime that you're making any type of investment decision, make sure you know the fundamentals about what you're getting into. Whether you're working with a syndicator or not, whether you're working with us, know the fundamentals of what we're presenting, because again, it has to be baked in today's reality, today's assumptions. So what you've heard and seen 2-3 years ago may not work today. So again, get down to the fundamentals of educating yourself of what potential opportunities that are there, what geographic submarkets that you want to be in. If we're really talking about diversification, like you said, David, take control over like your 401k and your retirement accounts so that you can guide them towards, really true diversification, right? Rather than, just relying on kind of, the standard of some of these retirement accounts. Mm-hmm. So I love that. So if there's a few takeaways from here, we talked about a lot of the reality of what we're hitting, but there's opportunity in everything. And so that's what I want folks to take away from this is there's opportunity even today, but secondly, educate yourself so you're making the right decisions for your family, for yourself, from a long-term perspective, and look at a long-term horizon rather than looking at, short-term wins, right? There's going to be a lot of up and down in the next 12 to 18 to 24 months. So, keep your head on a swivel, but look at the vision, look at the long-term vision of what you're trying to achieve, and set up sort of goals, that align to that vision. So I think those are some of the key takeaways that I heard from the discussion today that I think people can really, take and draw some actionable next steps for themselves, no matter where they are in their journey. Yeah.
Yeah. Well, very well said.
Well, great, man. This was excellent. This was a great discussion. I really appreciate you, taking the time to share your story. Really, it's inspiring to hear about your story, and I love, and Rav said it too, right? Like, clarity comes from, and you said it comes from steel, comes from hard times, comes from, and so we're in it now, looking at it, and some people might be going through that now, but use that as an opportunity to sharpen yourself, right, from those hard times. So I loved what you said, steel sharpens steel. So leverage other people that are going through this and benefiting from it. And so I really want to thank you, David, for sharing all of that wisdom and sharing your story with our listeners today.
It's my pleasure. Somebody once told me, and I think it's a great way to think about this, is that wisdom comes from having made mistakes.
Absolutely. Absolutely. You learn the most, I think, we've learned the most with some of the mistakes that we've made, and you fall from that and you learn very, very quickly versus, the regular education journey. So absolutely true. 100%. Awesome. Well, great. Thank you guys. And thank you to our listeners for tuning in to this episode of Spur Equity's Spur Your Wealth podcast. Again, we are your hosts, Param Singh and Rav Singh from Spur Equity. And remember, your journey to financial freedom begins with both knowledge and action, where knowledge is power,
but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.